Skip to content. Chat history. You said, "Give me a complete motivational speech on the title." Charlie Munger. Why you only need 3 stocks to retire early, without mentioning anyone by name. Before giving the speech, first write 6 powerful keynotes that summarize the core message and lessons of the title. In the introductory part of the speech, write the most engaging and impactful opening that captures the audience's attention and gives them a strong reason to watch the complete speech until the end. Why you only need 3 stocks to retire early. Most people believe financial freedom requires dozens of investments, endless research, and non-stop action. That belief is wrong. If you stay with this message until the very end, you'll discover why doing less far less can quietly outperform almost everyone else, and why a simple, focused approach can lead to an earlier, calmer, and more secure retirement than chasing the latest opportunity ever could. This isn't about shortcuts. It's about clarity. Because the truth is, wealth doesn't come from how many investments you own. It comes from how well you understand the few you choose. The illusion of more. Modern investing has trained people to believe that safety comes from owning everything. More stocks, more trades, more opinions, more noise. But spreading attention across too many decisions doesn't reduce risk, it creates ignorance. When you own a little bit of everything, you rarely understand anything deeply. And when you don't understand what you own, fear takes over. Fear leads to panic. Panic destroys compounding. True wealth builders don't win by being busy. They win by being selective. The power of 3. Imagine knowing just 3 exceptional businesses so well that you understand how they make money, why customers can't easily leave, what gives them long-term advantages, and why they'll still matter decades from now. With that level of understanding, market drops become opportunities, not disasters. Volatility stops being a threat and starts becoming your ally. 3 outstanding investments held patiently can outperform 20 average ones traded emotionally. Time is the multiplier. Compounding doesn't reward intelligence alone. It rewards endurance. The biggest gains don't happen in the first year or the 5th. They happen when time is allowed to do the heavy lifting. Selling early interrupts the very force that creates exponential growth. Retiring early isn't about timing the market. It's about staying in the market with conviction. Discipline beats genius. You don't need perfect forecasts. You don't need to predict recessions. You don't need to react to every headline. What you need is emotional control when others lose theirs. The ability to sit still while others panic is rare and incredibly valuable. Most people fail not because they lack knowledge, but because they abandon good decisions at the worst possible moment. Simplicity is a competitive advantage. Complexity feels smart. Simplicity works. When your strategy is simple, you stick to it. When you stick to it, results compound. And when results compound long enough, early retirement becomes inevitable, not stressful. Focus, patience, conviction. That's how a few well-chosen investments can quietly outperform a lifetime of overthinking. Final thought. You don't need to own the entire market to win. You don't need constant action to make progress. Sometimes the fastest way forward is choosing wisely and then doing almost nothing. Because in the end, wealth favors the calm, the focused, and the patient, and just a few great decisions held long enough can change everything. Wealth is built through concentration, not constant diversification, because extraordinary results come from a few exceptional decisions made correctly and held with discipline over time. Most people are taught that safety lies in spreading money across as many options as possible, but this often spreads understanding just as thin. When attention is divided, conviction weakens, and without conviction, every market movement becomes a reason to doubt, hesitate, or react emotionally. Concentration forces clarity. It demands deep thinking, careful judgment, and a willingness to say no to countless distractions. When you focus on a small number of opportunities, you naturally invest more time understanding them. You learn how they truly make money, what could threaten their future, and why they are likely to endure. This depth of knowledge creates confidence, and confidence allows patience to take root. Patience is what gives compounding the uninterrupted time it needs to work its quiet magic. Constant diversification often disguises fear as wisdom. It feels responsible to own many things because it reduces the discomfort of being wrong about any single choice. But avoiding discomfort also avoids excellence. Great outcomes rarely come from average decisions multiplied many times. They come from outstanding choices given enough room to grow. When everything is owned in small amounts, nothing meaningful can move the needle. The result is mediocrity disguised as safety. True risk is not owning too much of something you understand well. True risk is owning many things you barely understand at all. When markets decline, a concentrated investor who understands their holdings can remain calm or even take advantage of lower prices. A scattered investor, unsure of why they own what they own, is more likely to panic and sell at exactly the wrong time. Knowledge reduces fear, and concentration makes knowledge possible. Focus also strengthens discipline. With fewer investments, there are fewer decisions to make and fewer opportunities to make mistakes. Overtrading, chasing trends, and reacting to noise are behaviors that erode long-term results. Concentration naturally limits these impulses. It encourages a long-term mindset where success is measured in years and decades, not weeks and months. This shift in perspective alone separates those who build lasting wealth from those who remain stuck in cycles of activity without progress. Concentration does not mean recklessness. It does not mean ignoring reality or refusing to learn. It means choosing carefully, demanding high standards, and acting only when the odds are clearly in your favor. It means waiting patiently for the right opportunities instead of forcing action. This approach respects the fact that truly great opportunities are rare, and when they appear, they deserve meaningful commitment rather than cautious hesitation. Over time, concentration aligns perfectly with the power of compounding. A few strong positions, allowed to grow without constant interference, can produce results that far exceed what scattered efforts ever could. The biggest financial transformations are rarely dramatic in the beginning. They are quiet, almost boring, built on consistency and restraint. But as years pass, the difference becomes undeniable. In a world obsessed with doing more, owning more, and reacting faster, concentration is a form of quiet strength. It requires confidence to stand apart from the crowd and trust your judgment. It rewards those who value understanding over activity and patience over excitement. When focus replaces fear and conviction replaces confusion, wealth stops being a matter of luck and starts becoming a predictable outcome of disciplined thinking and long-term commitment. Deep understanding beats owning many average investments because knowledge transforms uncertainty into confidence, and confidence is what allows great decisions to endure through time. Owning many average investments may feel productive, but without real understanding, ownership becomes passive and fragile. When you don't truly know why something is valuable, every price movement feels like a signal to act, even when no action is needed. Understanding goes beyond reading surface-level information or following popular opinions. It means knowing how value is created, what could destroy it, and why the advantage is likely to persist. This level of insight cannot be achieved when attention is scattered across dozens of holdings. Real understanding requires focus, repeated study, and the patience to think deeply rather than react quickly. Average investments demand constant monitoring because there is no strong reason to trust them long term. They depend heavily on favorable conditions and momentum rather than durable strengths. As soon as conditions change, doubt appears. Deeply understood investments, however, are held with purpose. You know what you own, why you own it, and under what circumstances you would change your mind. That clarity removes emotional decision-making from the process. When markets fall, surface-level investors feel exposed. They question every position because their choices were never anchored in understanding. Those with deep knowledge see declines differently. They recognize the difference between temporary price movement and permanent damage. This distinction is critical. Most wealth is lost not because the underlying value disappears, but because people confuse volatility with failure. Owning many average investments also creates the illusion of progress without meaningful impact. Each position is too small to matter, and none are strong enough to lead. Results become dependent on overall market performance rather than individual excellence. Deep understanding allows you to concentrate on fewer, stronger opportunities where success is driven by fundamentals rather than hope. Understanding sharpens patience. When you know why something works, time becomes an ally instead of an enemy. You are less tempted to sell too early or switch strategies. Compounding requires trust, and trust comes from comprehension. Without it, even the best opportunities are abandoned before they can deliver meaningful results. There is also a hidden cost to shallow ownership: mental overload. Managing many average investments creates constant noise, distraction, and decision fatigue. This leads to rushed judgments and emotional exhaustion. Deep understanding simplifies life. Fewer decisions made with greater clarity lead to better outcomes and a calmer mindset. In the long run, success belongs to those who choose depth over breadth. One well-understood opportunity can outperform 10 mediocre ones held without conviction. Knowledge compounds just like capital, and when understanding is allowed to grow alongside investment, results become not only stronger, but far more sustainable. Patience and time are the true accelerators of compounding because growth is not linear, and the greatest results arrive far later than most people expect. Compounding works quietly, almost invisibly at first, rewarding those who can endure long periods where progress feels slow or even non-existent. Most give up during this phase, not because the strategy is wrong, but because impatience convinces them nothing is happening. Early returns are deceptive. Small gains seem insignificant, and short-term setbacks feel exaggerated. Without patience, people interrupt the process too soon, constantly resetting progress by switching directions. Compounding requires continuity. It demands that decisions be allowed to mature, uninterrupted by fear, boredom, or the desire for instant gratification. Time magnifies everything. Good decisions become exceptional, and bad decisions become disastrous. This is why patience must be paired with quality. When the foundation is strong, time becomes an unstoppable ally. But when people chase quick wins, they shorten the very timeline that creates exponential results. The real acceleration doesn't come from speed, but from staying in place long enough for momentum to build. Markets reward endurance, not urgency. Those who try to rush outcomes often end up overtrading, reacting to noise, and turning temporary fluctuations into permanent losses. Patient thinkers understand that volatility is not a signal to act, but a cost of admission. They accept uncertainty as part of the process and refuse to let emotions dictate timing. Time also reduces the need for brilliance. You don't have to be right often when you allow the math of compounding to work in your favor. A few sound decisions, given enough years, can outperform countless clever moves made in haste. This is why consistency matters more than intensity. Small advantages, applied repeatedly over long periods, produce extraordinary outcomes. Impatience creates friction. It leads to unnecessary taxes, fees, and mistakes that quietly erode returns. Each interruption steals from the future. Patience, on the other hand, allows growth to layer upon itself. Gains generate gains, and progress feeds progress. What feels slow in the beginning becomes unstoppable later. Time also strengthens conviction. As years pass and results accumulate, confidence grows, making it easier to stay the course during difficult periods. This creates a reinforcing cycle where patience leads to success, and success reinforces patience. Those who understand this stop watching the clock and start trusting the process. Compounding does not respond to pressure or force. It responds only to time and discipline. When patience replaces urgency, growth stops being fragile and starts becoming inevitable, quietly transforming long-term commitment into lasting financial freedom. Quality businesses held long-term outperform frequent trading because enduring value is created through stability, not constant motion. Frequent trading creates the illusion of control, but in reality it often replaces thoughtful decision-making with emotional reaction. Every trade introduces friction fees, taxes, timing errors, and stress that quietly works against long-term results. Holding quality allows value to compound without interruption. A quality business is one that can survive change, adapt over time, and continue to generate value regardless of short-term conditions. When such a business is owned with a long-term mindset, time amplifies its strengths. Innovation compounds, customer loyalty deepens, and advantages become harder for competitors to erode. None of this can be captured through constant buying and selling. Frequent trading relies on prediction, and prediction is fragile. It assumes that future price movements can be anticipated with consistency. Even when trades are occasionally correct, the need to be right repeatedly creates pressure and increases the likelihood of costly mistakes. Long-term ownership shifts the focus away from predicting prices and toward understanding progress. Instead of asking what will happen next week, the question becomes whether the underlying value is growing over the years. Emotional discipline is another advantage of long-term ownership. Trading encourages reaction. News, rumors, and market fluctuations become triggers for action. This constant stimulation makes it difficult to remain rational. Holding quality businesses reduces noise. When conviction is based on fundamentals, short-term volatility loses its power to influence behavior. There is also a compounding effect on knowledge. The longer a quality business is held, the better it is understood. This familiarity improves judgment and strengthens confidence during difficult periods. Traders reset this learning curve with every transaction, never allowing insight to fully mature. Long-term holders benefit from accumulated understanding, which becomes an advantage that compounds alongside capital. Trading demands attention and time, turning investing into a source of stress rather than growth. Long-term ownership simplifies decision-making and frees mental energy for higher quality thinking. Fewer decisions, made with greater care, consistently outperform many decisions made quickly and emotionally. Most importantly, quality businesses reward patience. As years pass, the gap between intrinsic value and market price often widens in favor of those who hold. Short-term fluctuations become irrelevant compared to the steady expansion of real value. Those who trade frequently often miss the most powerful phase of growth, exiting too early in pursuit of the next opportunity. Sustainable wealth is built by letting strong foundations carry the weight of time. When quality is chosen and patience is applied, effort decreases while results increase, allowing long-term ownership to quietly outperform the endless activity of frequent trading. Emotional discipline matters more than market predictions because the greatest damage to long-term success rarely comes from lack of information, but from poor behavior under pressure. Markets are unpredictable by nature, and no amount of analysis can eliminate uncertainty. Those who rely on predictions place their confidence in forecasts that are often wrong or incomplete. Those who rely on discipline place their confidence in their ability to remain rational when emotions are tested. Fear and greed are powerful forces. They push people to buy when excitement is high and sell when panic sets in. This cycle repeats endlessly, destroying value not because opportunities disappear, but because emotions override logic. Predicting the market does not protect against this. Emotional control does. The ability to stay calm during uncertainty is what separates consistent success from repeated mistakes. Discipline creates consistency. It prevents impulsive decisions and encourages adherence to a well-thought-out plan. Without discipline, even the best strategy fails. People abandon sound principles at the worst possible times, reacting to short-term losses or chasing short-term gains. This behavior transforms temporary fluctuations into permanent setbacks. Predictions also create false confidence. When someone believes they know what will happen next, they take risks that are not justified. When reality deviates from expectations, denial and hesitation follow. Emotional discipline accepts uncertainty in advance. It prepares the mind to handle outcomes without surprise, reducing the urge to react emotionally. Long-term success requires the ability to tolerate discomfort. Periods of stagnation, decline, or doubt are unavoidable. Those who lack emotional control seek relief through action, even when action is unnecessary or harmful. Disciplined thinkers understand that doing nothing is often the hardest and most profitable decision. Emotional discipline also improves decision quality. When emotions are managed, thinking becomes clearer. Decisions are based on evidence and logic rather than urgency or fear. This leads to better timing, stronger conviction, and fewer regrets. Over time, avoiding major mistakes becomes more important than making brilliant moves. Markets will always move in unexpected ways. No one can consistently predict them, but everyone can learn to control their reactions. Those who master their emotions gain an advantage that cannot be easily copied. While others are driven by headlines and sentiment, disciplined individuals remain focused on long-term value. In the end, success is less about being right and more about staying rational. Emotional discipline turns uncertainty from an enemy into a manageable reality, allowing patience, consistency, and sound judgment to compound into lasting results. Simplicity creates clarity, confidence, and lasting wealth, because clear thinking thrives when unnecessary complexity is removed. When strategies are overloaded with rules, indicators, and constant adjustments, decision-making becomes confused and inconsistent. Complexity gives the illusion of sophistication, but it often hides uncertainty and weak conviction. Simplicity, on the other hand, forces understanding and strengthens commitment. Clarity begins when there are fewer moving parts. A simple approach makes it easier to see what truly matters and what does not. When goals, principles, and decisions are clear, distractions lose their power. This clarity allows focus to remain on long-term value rather than short-term noise. Without clarity, even good opportunities are mismanaged or abandoned prematurely. Confidence grows from understanding, and simplicity makes understanding possible. When a strategy is easy to explain, it is easier to trust. Complicated systems often collapse under stress because they depend on precise conditions to work. Simple principles endure because they are flexible and grounded in reality. This confidence becomes critical during difficult periods when doubt and fear are at their highest. Simplicity also reduces mistakes. Fewer decisions mean fewer opportunities to act emotionally or impulsively. Each additional rule or position increases the chance of error. By narrowing focus, energy is directed toward the most important actions. Over time, avoiding unnecessary errors contributes more to success than chasing extra gains. Lasting wealth is built through consistency, and consistency is only possible when a strategy is sustainable. Complex approaches demand constant attention and effort, leading to fatigue and burnout. Simplicity is sustainable. It allows discipline to be maintained over decades, not just during periods of excitement or optimism. This endurance is what gives compounding the time it needs to work fully. Simplicity also encourages patience. When there is less to monitor, there is less temptation to interfere. Results are allowed to develop naturally instead of being forced. This patience reinforces confidence, creating a cycle where clarity leads to calm decision-making, and calm decision-making leads to better outcomes. In a world filled with noise, speed, and endless opinions, simplicity is a competitive advantage. It creates mental space, strengthens judgment, and keeps focus aligned with long-term goals. When simplicity guides decisions, confidence replaces confusion, and wealth becomes a natural outcome of clear thinking, disciplined action, and time. The path to early freedom is not hidden, complex, or reserved for the few. It is built on focus instead of distraction, understanding instead of noise, patience instead of urgency, and discipline instead of prediction. When attention is concentrated on a small number of high-quality choices, when those choices are understood deeply and held with conviction, time becomes an ally rather than an enemy. The temptation to overreact fades, simplicity replaces confusion, and emotional control turns uncertainty into opportunity. Most people search for more information, more action, and more certainty, yet lasting success comes from doing less, thinking better, and staying consistent longer. When clarity guides decisions and patience protects them, wealth compounds quietly in the background, not through constant movement, but through steady commitment to principles that endure.